Hi friends, I'm John. Welcome to the channel. In this video, I'm going to share some smart investing strategies that you can use to help grow your wealth no matter what the economy is doing. If you're new to investing, then this is going to be perfect for you. And if you're already making moves with investing, then I would bet that there's a few of these strategies that you're missing out on. So with that said, let's get into the first smart investing strategy for any economy. Okay, so unless you want to deal with more stress than you need to, investing into any asset, no matter what kind it might be, it could be stocks, bonds, crypto, real estate, a business even, whatever it might be, requires you to be prepared with a set of guiding rules. I think a big mistake that newbie investors make especially is going in without a plan for investing. It's a surefire way to lose money, and losing money isn't fun, so let's not do that. Your set of rules and systems are what inform your overall investment strategy, and they depend on things like your risk tolerance, your personal circumstances, your age, your available money, and your goals and investing objectives. Now, you may be someone who likes to be more conservative with their finances, or you may be someone who wants to make more aggressive plays. Either way, you want to actually consider questions like, what asset classes will you invest in? Equities on the stock market, debt securities, private businesses, real estate, cryptocurrency. Then within those asset classes, what are your guiding rules for each of them? If it's the stock market, will you go a little more risky and build your own collection of shares of companies to invest in? Or will you stick with the index funds and the ETFs? Will you lean heavily towards companies that pay dividends? If you're looking to allocate some investment dollars into real estate, what type of real estate will you target? If it's cryptocurrency, do you want to just put away some, long-term holds on big established coins like Bitcoin and Ethereum? Or are you wanting to dive more into learning about the altcoin projects and various other ways to invest in cryptocurrency? And then overall, are you looking to be more active in your investments, or would you prefer them to be a little more passive? Hey, dude, I'm sorry. I'm just a little excited. I'm editing this thing and I wanted to share something with these guys. Apparently. Hey, by the way, I would go back a few seconds, take a screenshot of what this guy just shared, and that way you can really consider them. Yeah, that's good advice. I would take it. Yeah. Back to work. Now, it's really good to have a well thought out investment strategy and a plan. But remember, just like a list of goals that you might keep, you should reevaluate your strategies from time to time as your personal situation changes. The next smart investment strategy is to pay off debts with high interest rates before you start investing, or at least have an aggressive plan in place to do so. Now, I know for some of you, this might come off as a buzzkill, but it's important that you understand how debt is affecting your potential to grow your net worth. Now, keep in mind, I did not say pay off all debt. Debt can be a good thing if it's leveraged properly, but if you're sitting on a mountain of credit card debt, especially if you're late on your payments, or if you have high interest student loans, then I would recommend you work to get those paid off first. And here's how I would recommend you look at this. Anytime you have unleveraged debt like credit cards, it is literally like taking money from yourself in the future every single month. Let's say your credit card comes with a 24% APR and you're carrying a $10,000 balance. What this means is that you'll be charged a total 24% of your $10,000 balance over the course of 1 year, assuming the balance stays the same. Now, that APR is applied to your balance at a rate of 2% every month. You take 24% divided by 12 months, and then you get the 2% per month. So in this scenario, every single month you're paying or effectively losing $200 on that $10,000 credit card debt. Multiply that by 12 months if you don't pay off any of that 10 grand, and that's an additional $2,400 you owe the credit card company. Now, in reality, the monthly interest charge is added to your overall balance. So it's possible that this scenario is even worse if your minimum payment is, less than your monthly interest charges. But for the sake of keeping things simple, we're just going to leave it at that for now. So by paying off your credit card in this example, you'd be saving the equivalent of what an investment returning 24% annually would give you. You take the S&P 500 as an example, it's performed at an average 13.5% annually over the last 10 years on average, which is a really good, rate for an index fund. So I think I've driven the point home enough. High interest debt like credit cards and student loans are expensive, and paying them off is better than getting any return on an investment that could be earning less than what your yearly finance charges are. So either get them paid off, refinanced, or be sure to set up an aggressive repayment plan before you start investing in other assets, and you'll get ahead faster. The third smart investing strategy is to set aside a specific amount of your income to invest and then stick to it. Now, sure, you might rearrange investment vehicles depending on the cycle or what's going on in the world, but the point is this: when you consistently put money aside for your investment strategy, it really adds up in the long term, especially if you're investing your profits back into your investment plan, which I would highly recommend you do, because investing your profits creates compounding. And over time, it is a very tried and true path to growing wealth. As Albert Einstein once said, he who understands compound interest earns it, and he who doesn't pays it. Very true. Consistently setting aside a portion of your income to go into your investment plan is what eventually creates those long-term big money growth charts. And the longer you do this consistently, the more profit you'll earn over your principal. Okay, next up is to diversify and spread out the types of investments you make. If you've heard this before, it's for good reason. When it comes to where you invest your money, you don't want it all in one basket. An easy way to do this in the stock market is to just invest in index funds. They constantly perform well, and they'll save you from having to study companies and listen to their earnings calls and know their PE ratios, all in an effort to make the right picks. I also believe that people should spread money out into other areas outside of the stock market as well. I'm personally bullish on cryptocurrency in the long term, for example, so I think that's an opportunity. Real estate is one of the best performing asset classes of all time. And of course, there's precious metals like gold and silver. And you can even join these micro investment apps and services now to invest in real estate and startup companies such as Fundrise, Yield Street, Microventures, and Equity Bee. Whatever you do, don't stick all of your investment eggs into one basket. If you're just starting out, you probably will have to pick one asset class for now. But as soon as you can, spread out your investments. And if you're already investing and you're not diversified, then consider this a little friendly nudge. Start doing so as soon as you can. The next smart investing strategy is more related to the stock market or cryptocurrency, and it is to understand and utilize what's called dollar cost averaging. If you've never heard of this technique, it's actually pretty simple. To utilize dollar cost averaging, simply invest a fixed amount of money consistently every week or every month, some specified interval, into the same asset. So instead of trying to time the market, you make smaller purchases over time. Now, a few things happen when you do this. Number one, you avoid trying to time the market, which, by the way, consistently loses to dollar cost averaging. And I'll illustrate that here in just a moment. Number two, you avoid the emotional roller coaster of manual investing and the stress that comes with trying to time the market. Number three, dollar cost averaging enables you to become a habitual investor, which I think the benefits of that speak for itself, as long as you invest smart, of course. Number four, you simply earn better returns when you invest using dollar cost averaging. History has proven this time and time again. Here's a quick example to bring this point home, and then we'll move on to the last smart investing strategy, which is a very important one and oftentimes is overlooked. So be sure to stick around for that. Now, let's say you were able to put $1,000 a month into the stock market. Maybe it's an index fund. So let's hop on over to the computer for this one. Okay, for sake of keeping this example easy to understand, we're just going to go ahead and use nice, easy round numbers. So these are just example numbers. They're not real numbers. So here you can see up in the columns, we have month, cost per share, number of shares purchased, and amount spent. Then we have in rows, numbers designating each consecutive month, total shares purchased down here, and then lastly, average share price. And there's some other stuff here. I'll get into that in just a moment. Now, we've got two of these tables, one to illustrate investing in one lump sum, and the other to illustrate what dollar cost averaging might look like. So let's say you threw $6,000 in here at the beginning, with the investment having a share price of $50, which would get you 120 total shares, having spent a total of $6,000. Now down here in the dollar cost averaging table, let's say you took this $6,000 and split it up evenly over 6 months, investing $1,000 each and every month. Now, because things fluctuate in the stock market, let's say month one, the share price was $50, month two was $45, we'll say month three was $40, month four was $45, month five is $50, and then we'll call month six $55, ended up a little high. Okay, so none of these months represent more than, a 10% swing. So we want to keep it realistic, no wild swings or anything like that. So when we add in the $1,000 for each month over here, okay, this table in the middle is going to automatically add in the number of shares purchased based on a quick cell calculation that I just put into the spreadsheet. So as you can see, we end up with an additional 8 shares versus what we would have ended up with had we ended up with, or invested just one lump sum, right? Okay, so the average we paid per share by DCAing in was only $2 less than if we had invested with that lump sum. But because of how dollar cost averaging works when it comes to, some simple math, we end up with $7,019 instead of $6,600. which was calculated by multiplying how many shares we got originally with that money, and then what those shares are worth at the end of this 6-month time frame, which is $55 each. Now, the difference in terms of return between these two are over to the right of the tables. So in the example of investing with one lump sum, we ended up with a 10% return, which is actually pretty decent. But by utilizing the power of dollar cost averaging, we ended up with 7% more at a total return of 17%. And 7% difference is a big deal when you're talking about money, especially when you factor in compounding and going long term on things. So I hope that example makes sense. Of course, this is also applicable to cryptocurrency. For example, you can dollar cost average into Bitcoin or Ethereum. Exchanges like Coinbase actually make that really easy. And I'll go ahead and leave a link down in the description for Coinbase. And if you sign up for an account, you'll receive $10 worth of free Bitcoin. Onto the 6th smart investing strategy. And this one is extremely important. And it is to never invest more than you can afford to lose. At the end of the day, investing is a risk. And yes, there are ways to mitigate risk. Be smart about it with all the things that we've talked about in this video. You've got to understand that there's risk associated with investing in anything. Know what you're investing in. Take some time to understand it, and always do your own research no matter what advice you hear on YouTube or on social media. Emotions are a dangerous thing, especially when you're dealing with FOMO, which stands for fear of missing out. So by applying this rule of not investing in something unless you could financially survive losing it, then you'll be in great shape if a disaster does strike whatever asset class you're invested into. By the way, I'd love to know, what asset classes are you most interested in when it comes to investing? Drop a comment down below, and then of course hit that subscribe button and tap on the notification bell right below it so you don't miss a single video. And then after you do all that, smash that like button as hard as you can, all that fun stuff. I hope this video was valuable for you. Please share it with a friend or a family member if it was, and I'll see you in the next video.